Thanks everyone for joining us today to talk about startup valuations and negotiations. I'm Alexander Morsink, co-founder and managing director of Equivesto. I'm also an angel investor, and I'm a startup mentor advisor at multiple accelerators and universities, and a great happy supporter and partner of TorontoStarts. My company, Equivesto, is a Canadian online investment platform and investment crowdfunding portal. We're licensed as something called an exempt market dealer. And essentially, we help connect companies looking to raise capital with investors looking to invest in early stage companies, make the whole investment process easier with due diligence and deal structuring. Since our launch 3 years ago, we've helped raise over 50 million for early stage and private Canadian investment opportunities from over 4,500 investors. It's probably gone up since I prepped this slide, but it's about a month old. So you'll have to check the website to see the current stats. So we're here today to talk about really some core facts around startup valuation methods, some of the different ways you can value startups, and actual negotiations with investors and how to go through that. So I think the main area of focus that's going to be the most useful and the most sort of room for discussion is going to be around the negotiations piece. The valuation methods are pretty straightforward, and there's a few kind of standardized ways to look at how to value companies. So I'm going to try to cover that relatively quickly to leave time for a lot more discussion and conversation around the negotiations piece towards the tail end. And then, of course, we'll have questions after the presentation. So before I dive into it, I always like to have this disclaimer at the beginning of any presentation I do, specifically on the difference between startups and small businesses. So technically, all startups are small businesses, but not all small businesses are startups. And the industry that we operate in, and specifically the startup industry and the startup community, has actually a pretty tightly defined definition of what is a startup. So I'm just going to define startup and small business quickly just to highlight those core differences, because the way you would operate your business and the way you would raise capital for your business and a variety of other things would be different between the two. So a startup is typically technology driven. They're targeting a large market of over $1 billion, either nationally or globally. They have a core unique differentiator that separates them from their competitors. They're planning to rapidly scale over the next 5 years, including hiring many more team members and expanding into more markets. To do that and to expand at that rapid pace, they're planning to raise capital multiple times from external investors to drive that growth, typically angel investors and then venture capital firms and then private equity firms. And because they're bringing on so many external investors, the founder is going to be heavily diluted in their ownership. And so that's part of this expectation. And then, of course, there is clear planning for an exit opportunity for those investors. And by exit, I mean an opportunity for those investors to sell their ownership and get paid out and hopefully generate some really positive returns. So all of those pieces are basically required for you to be defined as a standard startup in the sort of startup international ecosystem. Now, a small business I would define differently. It doesn't have to be technology focused. It can be local market focused and is typically owner operated. They're not necessarily expecting rapid growth or scaling at 200 to 400% per year. They don't necessarily have one core unique selling point or are aggressively diversified and differentiated from competitors. And they're not necessarily planning to raise capital multiple times from external investors, and they may not be planning an investor exit. A small business might be an Etsy shop or a local restaurant, or a little consulting business that you're running. A startup would be something like Uber or Facebook, or a technology-driven platform that's selling a software product to large other corporations. So with those two definitions outlined, most of this presentation around valuations is going to be directed towards startups. It's going to be talking about the methodologies for valuing startups and then negotiating with investors from the startup perspective and investors in startups. Small businesses would be valued in a totally different way. And being quite direct, there would be a much, much smaller number of investors who would be interested in investing in small businesses. Probably 95% of early stage investors, like angel investors and venture capital firms, are interested in startups and not as much small businesses. There are a number of capital opportunities for small businesses, but that's not what we're talking about in today's presentation. So the first valuation method that I want to talk about is comparables. This is probably the easiest one to access. It doesn't require necessarily as much work or calculation specifically around your business and what your business is doing. It's essentially finding other startups in the same industry, in a similar stage or size as you, and try to figure out their raised terms and valuation from press releases or other information that's been published on things like Crunchbase, and then slightly modify that valuation based on differences in stage, market, risk level, team, and traction. And the comparables method is sort of trying to do an apples to apples comparison. So you'd say, okay, I'm a B2B SaaS company that works in the telehealth industry. Over here is another B2B SaaS company that works in the telehealth industry. They raised a seed round with $100,000 of revenue at these type of terms and this type of valuation, also in Canada. I'm in Canada, so I'm going to look to do something similar. I'm a little bit further than them in my revenue. My revenue is more like 300,000 ARR, and so I'll be able to ask for a slightly higher valuation as long as that investment took place in the same sort of time horizon. You can't be, now we're in the later portion of 2023. We've had the collapse of the startup valuation market, since February. You couldn't go back and look at a valuation of, 2021 or 2022 and say, oh, look, here's a SaaS company from 2022, same stage as me. They raised at a $15 million valuation for their, Series A. I want the same thing. That's not going to be realistic. So you need to make sure you're matching, the market and the timing as well. But comparables is really about trying to do an apples to apples comparison between yourself and other companies. You need to be able to have access to research and information to be able to do it effectively, but it can be helpful to find a benchmark where you will be landing for your valuation. So why would you use the comparables method? It works well for other pre-revenue companies who are at earlier stages. It's useful if you're in a broad industry, which has a number of other companies that have been operating in it that have raised recently. So it's easier to make comparisons. And it's a good way to leverage social proof and the impacts of other VC investments. So you can say, look, these other VCs invested in this company in similar stage. We are comparable, or we're doing better than that company. That's why we would make a good investment. Some of the weaknesses of the comparables method is that it really removes some of the differences between the two companies. You're boiling down your value to, I'm in this industry at a similar stage and revenue mark to this other business. And it's taking out the team, the quality, the approach, maybe even the business model. All that is kind of being removed. And it's assuming that all companies are worth really the same and they're equally competitive, which is not true. And this really only works effectively if you have recent raises and are similar market conditions to compare to. So the challenge being, since February 2023, there've been a lot fewer early stage investments taking place, and so there's less data out there to directly compare to. A lot of investors were concerned about being the first ones to sign deal terms as the market was falling, and so there's not as many deals to say, okay, this was also in a similar company as me at a similar stage, and so it'll be harder to actually figure out exactly what those terms are. So you may want to use one of the other methods we're talking about today. So I just want to talk about the next method briefly, which would be stage benchmarking. So this is slightly similar to what we had just talked about, which would be the comparables method, but this looks at the general stages almost of all startups. Now, what's really critical for these stages is that your business has really, it really does qualify as a startup. That's kind of the minimum requirement to even be looking at something like this. And again, these stages are sort of generally standardized, but since February 2023, a number of these valuation ranges have fallen, especially in Canada. One thing that I do want to highlight before I even dive into the stage benchmarking is stages and valuations can be very different from country to country. So you could go on, VC Twitter or startup Twitter or X, or you could be looking at, Crunchbase, or maybe you're on a newsletter that's based out of the US talking about raises. The numbers that you'll be seeing there in terms of, pre-seed valuation, seed, Series A, things like that, and raise amounts is not going to directly translate one-to-one to your ability to successfully raise in Canada and even get a similar valuation and raise amount. Canada is much more conservative than the US when it comes to early stage investing. So you're going to need to reach the equivalent later stage and you'll still be getting a lower valuation and a lower raise amount. But let's break down some of these stages in general. So at first we have the beta stage. So this is when you're sort of at your pre-seed stage of the business. You're probably going to be getting a sub $3 million Canadian valuation, and you should be raising less than $1 million. At this point, you are really getting started. You're building your minimum viable product, but it's not even fully completed yet. The next would be the MVP stage. So this would also be called your seed stage. So here you've completed your MVP, you're ready to approach the market, but you have only just approached the market or you haven't actually fully done that yet. So you still have quite lower revenue. So here you'll probably get it somewhere between a $3 to a $10 million Canadian valuation, and you would be raising somewhere between 1 and 3 million. Now, since 2023, and the whole changes that have happened, it's really more between like a 3 and maybe a $7 million valuation range we're seeing in Canada. And even the raise amount has fallen. So it's more of a 500,000 to maybe a $1.5 million valuation, a raise range, and not a 1 to a 3 million like we were seeing before. The product market fit stage is also referred to as the Series A. So there's a large jump up between seed and Series A, and so there's some people even doing a seed part 2 raise to try to sort of cover off the middle. But essentially, once you've reached this stage, the product market fit stage, that's where you're going to start potentially actually trying to raise from venture capital firms. And the key indicator of how you know you've reached the Series A stage is you have over $1 million in annual recurring revenue. That's really the benchmark for arriving at Series A. So for Series A, you're probably going to be getting somewhere between a 10 to a $30 million valuation, and you would be raising somewhere between $4 and $10 million. Now, since again 2023 in Canada, a Series A, your valuation is probably going to be somewhere between maybe 10 and 15 million. You're not going to be getting towards those sort of $30 million valuations. That's a bit less likely, and the amount you're raising is probably more like between 2 and 4 or 5 million, not between 4 and 10 anymore. After that, the scaling stage. So this is Series B plus. So at this point, you're only raising from VCs. The raise amount is too far beyond angels. So angels aren't really participating anymore. It's very much in the venture capital space for Series B and beyond. Your valuation is typically over $30 million Canadian, and you're typically raising over $10 million. And then finally, you're doing a series of additional raises, potentially building towards your exit. So this, again, is a good for sort of benchmarking. So you're looking at, okay, what am I doing? Do I have revenue? Have I completed my MVP? Do I have over $1 million in annual revenue? That allows you to kind of place yourself roughly in one of these categories and see, okay, is sort of what I'm doing roughly making sense here? And you would add that with the comparables methodology to try to just find a general range that makes sense. You want to make sure you're in the right ballpark before you're kind of moving forward from that. As I mentioned, some weaknesses of the benchmarking is they're quite different sort of country to country. So a lot of these labels would not necessarily apply in the US, and they would have sort of different meanings, different raise amounts, different valuations, and it can be overly general. And so it's really just assuming that you are a startup fulfilling all of those sort of startup definitions, you're doing well, you have a great product, all those things are sort of required for the scale to be even applicable. Now, the next method would be multiples. So the multiples valuation method is the most effective when you already have consistent revenues. So multiples is a method that looks at the valuations of other companies in the same industry. And you basically can then create a relationship between the valuation of those companies and some sort of results that the company is generating. So typically it would be revenue, sales, EBIT, EBITDA, or net income, some sort of income statement line item. And you can find a consistent sort of relationship between one of those numbers and the actual value of the company. So sometimes we'll see that, tech companies on the stock market are trading at a 30 times revenue multiple or something like that. So in that scenario, you would say, okay, for this industry, it's become standard that B2B SaaS tech company, and I'm making these numbers up for example purposes, but a B2B SaaS company in the public stock market typically gets somewhere between 20 to 30 times whatever their revenue is. That's kind of where the market is comfortable with their valuation. Once you've figured out what that multiple is for your industry, so okay, I'm in biotech, so my multiple is 15 times net income, or it's whatever the number is. You can then simply apply that standard multiple to your own financial results and see where you end up. This is a useful methodology because this reflects how the market is going to value your business at a much later stage. So when you're considering investment or selling to a private equity company or to a much larger corporation in your industry, or even going and IPOing, the multiples methodology is really how you're most likely to be valued at those later stages. And so using that earlier helps you sort of map a little bit of a progression, and it lets you see where your valuation could potentially end up, what people are going to measure you against down the line. And that becomes important because as you look to raise more and more money from professional investors, those professional investors make their money when the exit happens. And typically the exit is going to happen based on a multiples valuation. So those investors are always thinking about your business from the perspective of, how am I going to be able to make my return? If I'm investing in this company and it's a Series B, I'm going to, be involved for 1 or 2 more rounds, and then hopefully they'll IPO. When they IPO, they need to reach these revenue targets because they're in this industry, and this industry has this revenue multiple, and that's what I need their valuation to hit when they finally IPO in 3 or 4 years. And that helps you understand why some of those internal targets regarding revenue or traction are being set. It's really helpful just having those awareness so you can communicate with investors in a more effective way. Some of the weaknesses of the multiples methodology is this is only effective for businesses that already have really clear revenues, EBIT, or other types of traction. So it doesn't work well for very early stage companies that are still in the sort of really rapidly growing stage where you have very minimal revenues. And depending on what the standard multiple is, for example, if it's based around revenue or sales, it then ignores some really key differences between companies and how they operate, specifically around profitability. Since the sort of collapse of the startup market in 2023, profitability has suddenly become so much more important. For a very long time, the focus was entirely around growth of the revenue. And why is that? Because when the company would IPO, everything was based around a revenue multiple. But focusing on the revenue multiple led the entire market to ignore the fact that companies actually exist to make profits for their shareholders. And at the end of the day, that's how people make money. And so if you focus on growth before everything else, you can have a really huge company making tens of millions of dollars in revenue. But if it's not profitable, you're losing money for every dollar you make. So through 2023, we've actually seen a really strong increase in focus on profitability or timeline to profitability if you're not profitable already. Most investors, VCs and angels alike, want businesses to be able to operate under their own power, and then additional capital goes in to help them grow, but not keep them afloat. So you want to make sure that even when strategizing for your own business, you understand what it's going to take to get yourself to profitability, and you do as much as you can to get yourself there or stay there first and focus on the rest after that. So finally, we come to the discounted cash flow method. So this is my favorite, or a version of this is my favorite valuation method for early stage companies. And essentially with the discounted cash flow method, you start with strong 5-year annual financial projections for your business. They need to be realistic and having logic-based assumptions is really critical to the success of this, because this whole model is based around those 5-year projections making some sense. Now, it's 5 years, so no one is actually expecting those 5-year projections to come true, but it's really making sure that the thinking, the thought process, the analysis that goes into those creating those projections makes a lot of sense. Having these projections need to have strong assumptions that make sense, but it also needs to show the long-term potential of the business as seen by the founder to potential investors. That combination is sort of hard to figure out and get right. But if you're able to do that, you would then take those 5-year annual financial projections and discount the annual cash flows from the business back to the present date. So basically, you'd be looking at the net profit of each year, and then you discount them back using a set discount value. So I've got the net present value actual calculation on the slide, and essentially you would add together all of those discounted values brought back to the present, minus the investment that's needed to achieve that, and that would get you to the actual present value of the company based on those 5-year projections. So why is the discounted cash flow method useful? It works for early stage companies that don't necessarily have a ton of revenue yet. It's built around the potential of the business in the future. And it really allows for differences in how the company will be run to follow through, because it's focusing on the net profit each year, not on just the revenues. And it also helps demonstrate to investors some of that long-term potential that the founder sees in the business with those potential revenue numbers and profit numbers in sort of year 5. Some of the weaknesses of this method is that having strong financial projections and really, really good assumptions is critical to the success of this method. Also, the discount rate that you choose plays a major factor in what valuation you're going to end up with. On this slide, I used a discount rate of 20% as an example because that's typically something that's used in finance textbooks. But in reality, when I'm valuing an early stage startup, because the risk level is so much higher for an early stage startup, I'm typically starting with a discount rate of 90%. And then as I find other aspects of the business that are stronger, like a great team or good traction so far, good product market fit, anything like that, I'm then reducing that discount rate from 90% downwards. I don't think I ever go below 40 or 45% for an early stage startup, even some of the strongest ones, because I really want to make sure that the risk associated with that investment is reflected in that discount rate. Another weakness is that investors need to understand that the projections being presented by the company, especially at this early stage, are not a promise or should even be an expected outcome, but are a logic-based vision for the potential of the business. When you're providing those financial projections, it's important that people understand there almost is no reality where you're actually going to hit those, revenue or profit numbers that you're targeting in year 5, but this is what you believe the business has potential to do. And then another scenario basically takes, called the Chicago method, takes that discounted cash flow methodology and applies it to 3 distinct financial projection scenarios. So you would create an optimistic 5-year projection, a moderate 5-year projection, and a conservative 5-year projection. And then you would multiply them by their percentage probability and add that together. Chicago method is effective, but it's highly technical. You have to be able to create 3 different sets of 5-year projections, understand the differences, and understand the weighting of each. So it is a bit more challenging to use and is a bit more financially technical. So those are some of the core ways to value early stage companies. So just as a recap, we have the comparables methodology, we have the stage benchmarking, we have revenue or other multiple methodology, we have the discounted cash flow, and then we have the Chicago method. Now, what's important to keep in mind is at different stages, your company is going to use different valuation methodologies. For example, as an earlier stage business, you have limited or no revenues. And so your valuation must be based on the future potential of your business. As your company is growing and growing and becoming more successful, moving towards an exit, you will see your valuation change and be calculated more in line with how public companies are valuated, which is going to be around that multiples calculation. Private equity firms start to look towards how companies will be priced when they plan to exit. And so, as I mentioned, multiples kind of become standard at the later stage, as well as, additional methods to support the multiples, but multiples become kind of the core of it at later stages. Earlier stage valuations can't really rely on core revenue or profit numbers to really lead that valuation. And so you have to look at a number of other factors, and so you have to use other methods. As a result, earlier stage valuations are more variable, and you need to use multiple methods kind of at once to support all of them together. So I would typically use the discounted cash flow method to come up with a number, and then I would right size that number using the stage benchmarking and the comparables methodology to try to find, okay, what actually makes sense and what fits. Now, it's important to note overall that all valuations are highly subject to overall market changes and especially country-specific market changes. I mentioned this earlier, but seed stage companies in the US, we're raising and have raised at valuations between $15 to $30 million. That's fallen a little bit as 2023 has progressed. But in Canada, seed stage means something totally different than the US. And seed stage companies typically raise at valuations between 5 and 15 million Canadian. So finally, and most importantly, valuation actually means nothing until somebody actually invests, signs the paperwork, and sends you money at that price. You can set your valuation wherever you'd like, but if nobody comes and invests at that price, your valuation isn't actually set there. You can almost think of it like you're selling fruit at a fruit stand. If you put an apple on sale for $50, you're saying the value of that apple is $50. But if nobody comes and buys that apple at $50, the market has told you that that isn't showing what the market feels is a fair valuation for that apple. So you got to reduce your price all the way down to maybe 50 cents or $1, and then you'd start to see people being interested in actually transacting. And that's when you've actually found an acceptable market price for that apple. And the same thing applies to your business. So we hurried through the valuations piece to get to kind of the core area of discussion for today, and also to leave time for questions. And what's really critical to think about is the negotiations aspect of your capital raise. So when you go out to raise capital from investors, that's typically going to be, certainly for early stage companies, it's going to be angel investors or it's going to be venture capital firms. And there's a few really important things to think about when it comes to the strategy around how you're setting up your raise, how you're negotiating it, and how you're actually planning and working with different investors to move everything forward. So the first area that's really important for a founder to think about and understand when it comes to negotiations is the difference between control and ownership. So a lot of times when you think about who owns a company, but also the control of the company, you're focused on the number of shares somebody has and the votes that they have associated with those shares. That's often the focus of a founder. And so as a founder, you're like, I want to give up as few shares as possible. I want to make sure no matter what, I have over 51% ownership of my company by the end of it. I want to make sure I'm in charge and controlling it. Now, the reality of raising as a startup is you're going to be giving up shares. You're going to be giving up ownership of your company at each subsequent round that you do. And so you need to be willing and expecting to end up with probably between 20 to 30% ownership of your company by the end, by the time you finally exit. But from that ownership conversation, I want to highlight that ownership is very different from control. When you're getting started as a founder, you are the 100% owner, so you're the sole shareholder. You're probably also the only director, so you're the only person on the board of directors as well, and you're the CEO, and you're the only employee. So you're filling all of these roles at once. As you grow and bring on more investors, those roles will start to separate, and it will really become clear that directors of the company, people on the board of directors, those are the people with the actual decision-making power and control over the business and what it does. And so even if you had 99% share ownership, if you were sitting on a board, you were a member of a board, and the board had 4 other people, so it was 5 people on the board, and those 4 other people were appointed to the board sort of for life. You couldn't get them off the board. Even though you owned 99% of your business, you would actually only have 20% control of your company because there are 5 people on the board and each person would have 1 vote. So when you're thinking about capital raising and going out and bringing on other investors, you're going to be giving up ownership percentage. That's okay. That's to be expected. What you want to be thinking about is, okay, who am I bringing onto the board? What does the board control look like? And again, it's not actually about controlling your board and making sure you always have, over 50% of the board seats. Because again, over time, you raise your seed round. Typically, the lead angel is going to get a seat on the board, and then you raise your Series A. The lead VC is going to get a seat on the board. Eventually, you're going to be in a position where you have minority board control as well. It's not about maintaining 51% control of anything. What it's about is making sure that the people you bring onto your board, the people that you allow and give control of your business to, are people who you trust, whose opinions you value, and who you actually want there as a check, as a control measure on you as the founder. If you think about it from the perspective of trying to protect and ensure the best possible outcome for the business itself, and the business being a separate legal entity from you as a person, it becomes really, okay, as we're growing, you recognizing, okay, there's not going to be always areas where I have the ultimate expertise, but there's also going to be areas where I'm making mistakes or choosing the wrong thing. I want to make sure that my board members, the people on my board, are there as trusted checks and balances on me, so that they catch me before I make a mistake and can help all of us together make a better company. So that's very, very important. But I just wanted to highlight the difference between ownership from a share percentage perspective and control of the business from a board perspective. So that is a really critical aspect when it comes to negotiations and investments. The next would be the actual negotiations around the valuation itself. It's really, really possible to lose the forest for the trees in this type of scenario. So you can be too focused on getting a high valuation in your raise, and you can overlook other critical parts of the negotiation, including making sure you have extra space for future rounds if things don't go according to plan, rewarding and protecting early investors and backers, and you can accidentally sacrifice in other areas of the negotiations to secure a higher valuation that would potentially be areas that are more meaningful for you to protect. I'll give you an example. If you're raising at a seed round, maybe the investor comes in and it's talking about a $5 million valuation, and you really want a $10 million valuation. If you push really hard and you get that $10 million valuation, if you need to raise again in the future in about a year and you haven't been able to hit all of the milestones that you wanted to reach, you haven't left yourself any extra wiggle room to really raise the valuation if you haven't done that much more. And so raising again, at the same valuation would be problematic. At the same time, if you raised a little bit lower, 8 million or 7 million, and you left a little bit more space, that allows you to, if you need to raise again, slightly raise the valuation and protect yourself and protect the other investors. Also, typically the first rounds that companies will close will be with friends and family, people that you know immediately who believe in you. These people are coming to invest in you personally because they believe in what you're doing, they care about you, and they want to support you. These people are among the least likely to fight you on valuation. Now, the challenge then becomes, if you push for too high of a valuation with these individuals, when you go out to the market where realistic professional investors are, those investors might not even be willing to invest at the same valuation that you push for with your sort of friends and family round. Those people would then say, no, you need to raise at a lower valuation, just more realistic for your business. And if you do really need the money, you might need to go ahead and accept that valuation. What you've then just done is you've actually lost money on the investments made by those early stage backers. And essentially you have punished your friends and family for believing in you. So you want to make sure you understand what's realistic and what you can expect to get from angels or from a VC, and price your family and friends round lower than that, so that you're not accidentally screwing over your family and friends for believing in you. And then finally, valuation is obviously something that takes a lot of focus during negotiations with a VC or an angel when it comes to investing. But if you focus too much on that valuation number and you give up too many other points, you can actually put yourself in a position where, even though you get a really high valuation, when it comes to actually the exit and getting the money out of the company does have a higher valuation, but you as a founder are getting much less because you've sort of ignored some of these other important negotiation areas and just focused on valuation. One example would be a lower valuation and no 2x liquidity provision is better for you as a founder than a higher valuation and 2x liquidity protection for investors. So what are liquidity preference positions and what is a preferred position? As you start to raise capital from larger, more professional investors like venture capital firms, they will typically take preferred shares when you're starting to raise at those later stages. When they participate and take preferred shares, those shares are called preferred because they have additional protections over other shares. When you're raising earlier, you're typically raising through a SAFE or convertible note, which I'll talk about in a moment, or through common shares. Those are the shares that you would have as the founder. Professional investors coming in are then taking preferred shares, which are given preferential treatment over those common shares when there is an exit or the company is dissolved. One of the core aspects or potential benefits given to preferred shares would be something called liquidity preference or a liquidity provision. Essentially what this means is, okay, there is a guaranteed promise to pay back those investors some multiple of the amount that they originally invested into your company. So for example, if somebody invests $100,000 and they buy preferred shares with a 1x liquidity provision, when the company is sold and the money's being divided up, at a guaranteed minimum, they at least get their $100,000 back out. So if they invested $100,000 and the company's valuation was $1 million, so they got 10%, amazing, you go off, things don't go the way that you planned. And so you end up selling the company not at $1 million that they invested at, but you sell the company for just $100,000. In that scenario, because of the one-time liquidity provision, you as the founder would get $0 and the investors would get the full $100,000 that the company was sold for because of their one-time liquidity provision. There are some terms that even include 2 times or 3 times liquidity provision. So you want to make sure you understand what people are asking for and what you're willing to sort of give up in terms of liquidity or preferred positions there. There's other special terms also typically provided with preferred shares as well. A standard preferred share in a small business world would have no voting rights, but oftentimes in a venture capital space, preferred shareholders not only do get voting rights alongside common shareholders, but they typically get permission to put somebody on the board of directors that's chosen only by the preferred shareholders. Finally, let's talk about actually how you're structuring your raise. So everyone's heard about SAFEs, convertible notes, or priced equity round. Just at a very high level, a SAFE, so a simple agreement for future equity, is really a type of investment or a structure for raising capital that really protects the founders most, but is actually the most risky for investors. So that's ironic. It's called SAFE. It's the least safe for investors. And essentially, it allows you as the founder to take in money and not really have to give much to those investors until a future round happens, where that SAFE would then convert into shares. A convertible note is protection for investors, but slightly riskier for founders. It takes the sort of idea of a loan and then makes that loan convertible into shares if the founder is able to raise successfully again in the future. But convertible notes, unlike SAFEs, typically have a maturity date, so a date where the loan must be repaid, and also typically have an interest rate. Now, the interest isn't paid on a monthly or annual basis, but it accrues, it adds to the total amount that's owed or converts at the time that the maturity or the conversion happens. Finally, equity is the most equal for everyone. So it's not a SAFE, which is protection for founders, or a convertible note, which is protection for investors, but it's just giving straight ownership of the company. But it does require more work because you do have to finalize and agree on a valuation for the shares at that time. So a few other important things to consider and talk about regarding negotiations, and maybe we'll get into this in the question section, is when to walk away, how to create win-win scenarios, who actually pays for negotiation and due diligence, how to value strategic investment, when to play hardball, and the art versus science of early stage valuations. So many of these things to think about are all going to be personal. They're going to be depending on your scenario and your raise. But before going in and before talking to any investors, you need to know what your baseline minimum requirements are to take the money. It's not simply, I need money, so I'm going to take it from anyone. It's a conversation and an agreement between you and the investor. The investor has to choose you, but you also have to choose the investor. So this is an opportunity to, one, know for yourself when to walk away, when you don't necessarily want to keep going and proceeding in that direction, and two, how to create a win-win scenario with yourself and the investors. Really, you're coming together to build a relationship and build a business that's going to work for both of you. And the negotiations you're going through to take their funds at the beginning, this is literally the dating before your proverbial marriage. And so, it's not like, okay, we just got to hurry up and get this done, and I'm going to fight tooth and nail for what I want, and then I'm going to get the money. It's going to be great. You then have a 5-year relationship with this person who's now invested in your company. So you want to make sure and even use this scenario to learn about the person who you're potentially having invest in your company and what that's going to look like. Now, who pays for negotiations and due diligence? This one, is not variable. It's cut and dry and very straightforward, and it's important to mention it to everyone. When raising capital, you will have a lawyer and your lead investor will have a lawyer. They will work with both of you when you're negotiating the terms of the deal, typically. In that scenario, both your lawyer and your investor's lawyer is billed to you as the founder. You can typically expect to pay somewhere between $20,000 and $40,000 for a seed round sort of legal support. And there's no additional investment from the investor to cover that cost. So you go out, maybe you're raising a $300,000 or a $500,000 seed round. You spend 20 grand on legal fees. They spend 20 grand on legal fees. You're spending $40,000 of that $500,000 that you just raised, paying for the lawyers that you both used. And that's quite standard. The only way sort of around this is if the person investing in you has so much experience and so much sort of standardized terms that they come prepared with a lot of these legal documents, and you're willing to accept that without fighting or without even having your own lawyer review it, which I do not recommend. So you should at least be budgeting, at the very least, $10,000 of the amount you're raising for your own legal fees to review all of this. And then if they have to have their own lawyer review stuff, expect to pay for that. Now, how to value strategic investment. Typically, if you're raising from angels or VCs, you want to be looking for smart money, not just passive money. By smart money, I mean investors who are not only bringing money to your investment, but also have their own connections, expertise, experience, or other things connected to your industry or your business that can bring additional value add. So that's kind of automatically, you should be looking for investors like that. Now, there are some scenarios where potentially the investment is by someone so directly connected to your industry that the value of having them come on board is so great, it's beyond just a normal smart money investment. And in this scenario, you need to take, there's probably going to be a different set of negotiations around what your valuation and the terms are going to look like, because there's so much potential value from working with this partner. You need to make sure to counteract that with some of the challenges or potential cons with taking that strategic investment, in the sense like you might be required to only work with this major player and you won't be able to work with competitors, or this organization might be almost kind of taking over your business and sort of using the business to focus on their specific pain points or challenges. So there are some risks with it, but sometimes strategic investments can have so much value that you're willing to give up other areas like valuation or other terms to really secure that strategic investment. Similarly, when you were figuring out personally when you need to walk away and when you want to exit, it's important that you also understand when you need to play hardball. What are the areas that are almost non-negotiable for you and are really important? And one of the hardest things to do as an early stage founder is turn down money when you really need money. But there are too many businesses that have taken money because they really needed it in the short term, and all they did was put off a problem or even create a much larger problem by taking money from the wrong people or people that weren't a fit. So you need to make sure that you know where your lines are in the sand in terms of yourself, in terms of the ethics, in terms of how the business is being run, and don't be afraid to say no and hold strong to things that matter very much to you. Finally, the art versus science of early stage valuations. We'd already talked about a number of different ways for valuing startups, but especially for early stage companies, it is that combination of art and science. You need to have numbers and information to back up your valuation, but part of it is just going to be, how do people feel about you as a founder? How do they feel about the team? Does it feel like you've really understood and you're in a great position to capture this market? And there is going to be that range of valuations because of that art aspect. It's not purely cut and dry. So you have to be keeping that in mind and thinking about ways that you can position yourself as a business that's going to help add some additional strength, sometimes even beyond just sort of numerical benefit, but making sure you've got a strong advisory board. You as a founder are engaging and showing that you're coachable and you're driven. All these things seem not as important, but can make a big deal. A lot of times when angels or early stage VCs are looking at companies, internally, what they're actually doing is they're betting on a founder. They're betting on you as a person and who you are and how you operate as being the individual that can make this successful. And so you want to make sure you're putting your best foot forward and representing yourself well so that people have more reasons to bet on you. So that ends the majority of the conversation we're going to have today about valuation and early stage capital raising negotiations. I can see a whole number of questions in the chat and the Q&A. So thank you very much for listening, and I look forward to answering them now. All right, let's see.
Sorry about that. I got my mouse cut out there for a second. Let's start with, what is the current investment climate? Are investors currently actively investing or holding back until the current quantitative tightening eases?
So it's a very good question. Every investors in general are pulling back, but there are still lots of deals being done and deals being made. It's more that investors are looking for the right deal in the right company at the right price. It's less kind of just firing or throwing a bucket of water at all startups, and more, using a water pistol to pick specific companies that really are, in their opinion, deserving of that investment. So it's almost advantageous to go out and be talking to VCs because there's not that many companies out there raising. So if you're doing a good job, you can stand out and make a difference. But you can't expect the same valuation, the same sort of terms that you might have gotten a year ago, 2 years ago. You need to be expecting something different, but there are certainly funds and investors out there with capital to deploy, even though, yes, from an investment perspective, it's important to keep in mind that the valuations are less and the stages are later. So for example, as an angel myself, member of an angel network, typically angel investments would be seed stage. So you would have no revenue, completed minimum viable product. That's where angels would participate. Currently now, every single deal needs to have revenue. If you don't have revenue, nobody will invest. So you at least need to have some kind of revenue and, of course, a completed MVP, and that will kind of get people interested. But your valuation is going to be lower. So before, it was a sort of $3 to $7 million valuation for a seed stage company, no revenue. Now it's 3 to 5, maybe $7 million valuation for a company that's post revenue over 100,000 or even beyond. Sometimes we even see companies raising at a seed stage $3 to $7 million valuation who have over $1 million in annual revenue already. So companies are being more competitive, and you're thinking about, okay, how do I get access as an early stage founder? At the same time, we have some Series A founders who have stronger revenue, but they don't have that profitability yet. Because they want to keep their business going, they're willing to really slash their valuation and come down almost to the seed stage investors. So you got to be sort of keeping aware of all the different players in that space.
How does Alex feel about the exempt investor regulations, specifically the accredited investor rules, which excludes the general public? Does Alex and the private equity company see these regulations as discriminatory and financially harmful to our economy by only allowing wealthy to participate in private equity investments? Should these regulations be amended or updated, etc.? I'm allowed to gamble my money at the casino, but I'm not allowed to invest in my local startup. Over to you, Alex.
Well, that's a fantastic question. Whoever asked that, you must know me very well. So myself and my co-founder created Equivesto expressly to solve that exact problem that you highlighted. So I think what I would just mention is there are actually new rules that I personally have been involved in helping give feedback around and create, which allow the general public to invest in startups. It is now possible to do that. So I do not think we should remove the accredited investor rules or anything like that. Those rules are there. New rules have been added, a number of new rules actually, that allow people who are not accredited to invest in early stage startups. Does this require slightly more risk, slightly more work from the early stage startup to make that possible? Yes. But is it entirely possible? And can you do that to raise money for your company? 100%. So that problem has actually been solved. Feel free to head to equivesto.com/learn. You can actually look at all the different types of investors that can invest in early stage companies on the Equivesto website. Really, it is now up to the startup to choose if they want to make themselves open to investment from the general public, and they're willing to put in that work, because there is additional paperwork and additional protections that need to be put in place for the general public, which I 100% believe should be there, and they are good protections. So those all make sense. It's just, is the startup willing to put in that work and time to make that possible? If so, you can take money from any Canadian currently over the age of 18.
We've got what would the next steps be for us to connect with investors? And it's a pretty generic question. Pitch deck, plan, etc. And how could you guys help with that? So
Yeah. So
maybe, yeah, go ahead.
no, go ahead, Craig. Go ahead.
I said I was going to think, well, maybe you should talk about what resources are and what Equivesto does.
Yeah. So, from based on the information that you just sort of said and sort of what's kind of needed, it sounds like there's a lot of additional help that you need to do something called investor readiness. So that's getting yourself ready and in a position to start talking to investors. Part of what we do at Equivesto doesn't find investors for people. We don't source investors for you. What we do is we help get you ready for investment from both a organizational perspective, from a marketing perspective, but also from a legal and a structuring perspective. And then we help set you up to be able to raise capital in a streamlined digital way from investors that you attract. So getting investor ready takes a little while. You need a whole number of things. I'm going to say a bunch of words really quickly. So you need a completed pitch deck. You need a totally cleaned up corporate minute books. You need a data room. You need a strong pitch that you've practiced, and you need an investor outreach strategy. So those are all things that you would need to have and be organized to do. That is something that you can pay Equivesto to help you do. You can pay Craig to help you do that. There's a number of accelerators that you can pay to help you do that. You can also try to go and do it on your own for free. Equivesto.com/learn has a lot of free resources that you can take advantage of. But essentially, there's a whole number of sort of standard things that you would need as a startup to be able to go out and start talking to investors that are kind of expected across the industry. And those are some of the things that I just mentioned. So you'd want to make sure you've prepared those for sure.
Incredibly useful and insightful presentation. What is a realistic expectation for the amount of equity to relinquish during a seed stage evaluation?
Perfect. So if we come back here to my stage benchmarking slide, this is a really good slide to focus on to sort of figure out that percentage that's being given up. And so you can actually see in the valuation and the raise number, it's a ratio, right? If you need to raise $1 million and your valuation is $3 million, you are giving up 1/3 of your company, assuming that's $3 million post money. So you've got a pre-money valuation and a post-money valuation, and it's very straightforward. If your pre-money valuation is 3 million and you raise 1 million, your post-money valuation is 4 million. So the pre-money and the post-money language is just saying, what is your valuation either before or after this additional money is injected? And the additional money is literally just added like a plus to your valuation to determine what that number is. So if you're looking at using my 3 and 1 example, if your pre-money is 3 million and you're raising 1 million, you're giving up 25% of your company. If your post-money is 3 million and you're raising 1 million, that means your pre-money is 2 and you're actually giving up 33% of your company. You look at the ranges outlined here and you can see you're typically giving up somewhere between 15 and 25%, maybe 30%, but usually between 15 and 25% of your company with each subsequent round that you do. Now, it's exceptionally important to highlight when you are raising capital, you are not giving up shares that you, the founder, have, right? If you, the founder, have 100 shares and you go out to raise money from investors, I, the founder, am not giving up 10 shares to my investor who's coming in. It's not, there's only 100 shares. I have all 100 and then I give 100 to somebody else. If I was to give 100 shares or 10 shares to somebody else, the money would come to me as a separate legal person and not to my company. My company would get $0 in investment. When you're raising capital, the company itself is printing new shares out of thin air and selling those shares to the investor. So if I, the founder, have 100 shares and somebody's coming and they're investing and getting 10 new shares, the company is going to make 10 new shares, give them to this investor, and now the company in total has 110 shares. And I have 100 of that 110. When I go out to raise again the next time, more shares will be created. And so my ownership will be diluted, but so will be the person who invested in the subsequent round. So it's not, okay, I'm giving up 25% every time I raise and I'm raising 4 times, then I'm left with 0. That's not how the math works. The 25% is coming from everyone who's invested previously. And so there's a dilution factor that's happening for everybody.
Really appreciate you taking the time out of your busy day, Alex. Any parting words for our guests?
Thank you, everyone, for hopping on and joining us. I know it was a quick presentation, but would be happy to chat more with companies. You can check out equivesto.com/learn for more information and free resources from Equivesto. You can check out TorontoStarts.com for all the wonderful things that Craig is doing, and I know he's got lots of courses and other webinars and things that you can sign up with him. In terms of Equivesto's services, we can help with investor readiness and help you with an accredited investor or an angel round that you're looking to do. Or if you're looking to allow the general public in Canada to invest in your business and you're considering doing an equity crowdfunding round, we very much do that as well. So go to equivesto.com/learn if you want to learn more about any of those things or access our free resources. Thank you very much for your time.